Silver investors, 9 days on a calendar usually doesn't mean anything. But when COMEX has 102 million ounces of registered silver, 366 million ounces of paper claims, London lease rates at 6.3%, and a divided Fed, 9 days becomes a countdown to finding out if paper can still deliver metal or if this whole structure finally cracks. I'm OG John AG, and in this video we're going to break down what today's lease rate spike and FOMC minutes really said, why they both push contracts towards standing for delivery on March 27th instead of rolling, how the math on COMEX looks at different delivery percentages, and what each of the next 9 days actually means for anyone holding silver exposure into this potential squeeze. Segment 1. The setup, 102 million versus 366 million. Start with the simple numbers COMEX just handed us. Right now, registered silver on COMEX, about 102 million ounces. March futures open interest, around 366 million ounces notional. At 5,000 ounces per contract, that's roughly 73,200 March contracts outstanding. That gives you a paper to registered ratio of about 3.529:1. 3.5 ounces promised on paper for every 1 ounce currently tagged as ready to deliver. If everyone tried to stand at once, the system breaks instantly. It only works if most people roll or close before first notice. And up until today, you could still argue that's what will happen. But today, two massive signals hit. London lease rates screaming physical shortage now, FOMC minutes screaming policy uncertainty, no clear dollar bull. Those two together change the incentives for March longs. Segment 2. London lease rates 6.3% screams tight physical. This morning during the London session, silver lease rates spiked. Specifics. 1 month silver lease rate in London jumped to around 6.3%. What is a lease rate? It's the cost to borrow physical silver from a London vault for a period of time. Lease rates do not spike when metal is abundant and easy to find. They spike when someone urgently needs physical, vaults know inventory is tight, and they can charge more because the metal just isn't there at lower rates. Here's the paradox. While lease rates were jumping to 6.3%, paper silver was trading around $72 to $75 in Western markets. So you had physical market saying, scarce, pay 6.3% to borrow it. Paper screen saying, chill, it's just $75, nothing to see. That is not a healthy integrated market. That is a warning. Physical and paper are diverging. The cost of real metal is rising, even if the quoted price pretends otherwise. Segment 3, FOMC minutes. A divided Fed is not a strong dollar. Then at 2 p.m. Eastern, the Fed dropped its latest FOMC minutes. Key line from those minutes. Participants were divided on how restrictive policy should remain and how quickly to cut. In other words, there is no consensus around a clean, aggressive, higher for longer path. Some want to cut sooner, others want to wait. Markets interpret that as uncertainty with a hint of dovishness. No strong unified case for a decisively stronger dollar and sharply higher real yields. The tape reacted immediately. Gold rallied about $55 from roughly $4,138 to $4,093. Silver jumped about $3 from around $74.40 to $77.44. So in 1 day, you got a 6.3% lease rate saying physical is tight, a divided Fed saying macro supports holding metals, not dumping them. Both of those are independently bullish for silver. Together, they send one message to March longs. Why roll this contract out when physical is tight and policy is uncertain right now? Segment 4. The COMEX drain math projecting 95 million ounces. Now take those signals and run the numbers forward to first notice day on February 27th. As of yesterday, registered silver on COMEX, 102 million ounces. Since October 2025, when registered stocks were about 167.7 million ounces, COMEX has been draining at an average rate of about 785,000 ounces per day. From now until February 27th, you have roughly 9 days in this analysis. If the 785,000 Azari day drain continues, 9 days x 785,000, 7 million ounces more, leave. 102, 7M projects 95 million ounces projected registered inventory on February 27th. So on first notice, rough picture, available registered about 95 million Oz. Paper claims, March OI, 366 million Oz. That's still a 3.81 paper to metal environment, but the real question is, how many actually stand for delivery? Segment 5, delivery percentages, 3 thresholds that decide everything. The competitor breaks this into 3 scenarios, and the math is simple. 10% stand for delivery. 10% of 366 million here are 36.6 million ounces, against 95 million available. Coverage ratio, about 2.6.1. Stock still bigger than demand. Tight but manageable. COMEX can deliver and still have 1,060 minerações left. 20% stand for delivery, 20% of 366 mil, 73.2 million ounces, against 95 mil available. Coverage ratio, about 1.3.1, very thin. COMEX can deliver, but registered drops toward 25-45 million, depending on a bit of extra drain. Lease rates likely spike above 10%. Backwardation intensifies. Silver pushes toward 90, 110. 30% stand for delivery, 30% of 366 mem, 109.8 million ounces against 95 men available. Shortfall of sheeter, 15 other ounces right away. System cannot fulfill all requests with current registered. That triggers forced cash settlement on some contracts, rule changes, a two-tier market where physical trades at a huge premium to paper. Lease rates could spike to 15% plus, silver 120 plus as paper decouples from metal. So the entire fate of March comes down to, does delivery land near 10% orderly, 20% heavy stress, or 30% plus break? And today's signals, lease rates and FOMC, both push the odds up on the higher delivery scenarios. Segment 6. How 6.3% lease rates change behavior. Who borrows silver at 6.3% lease rates 9 days before first notice? 3 groups, and all 3 tilt bullish for delivery. Shorts needing metal to deliver. They're short March contracts and owe metal. They can borrow at 6.3%, deliver, hope price drops later to buy back and return it, or just buy back their short now and close the position. At 6.3%, borrowing is expensive. That makes closing shorts more attractive, which reduces selling pressure and tightens supply. Industrial users needing March silver. They have production needs next month. They can borrow London silver at 6.3% and roll futures, or stand for COMEX delivery and take metal at 77 silver. 6.3% makes borrowing much less attractive. Taking delivery looks better. That increases delivery demand from real users. Arbitrage traders exploiting backwardation. They borrow London silver, ship it, deliver against higher priced COMEX futures, and capture the spread. The fact that they are willing to pay 6.3% means the backwardation between London spot and COMEX futures is wide enough to justify the trade even after cost. That arbitrage confirms physical tightness. Spot futures through July. All 3 cases, shorts covering, industrials taking delivery, arbitrage confirming backwardation, are bullish for March delivery percentages. That's why the competitor shifts his scenario probabilities after today. Orderly rollover down to 30%, heavy delivery up to 40%, system break up to 30%. Lease rates at 6.3% moved the dial. Segment 7, 9-day roadmap, what to watch each day. Now, the day-by-day path to February 27 in this analysis. Day 1, today, Wednesday, lease rates spiked to 6.3%. FOMC minutes show division. Gold, 4,138, 4,193. Silver, 74.40, 77.44. Setup is complete. Bulls have momentum. Day 2, Thursday. Jobless claims at 8:30 a.m. Eastern, above 220,000. Labor weakening. Dovish Fed case strengthened. Metals extend higher. Delivery pressure builds. Below 210,000. Labor strong. Fed can stay restrictive. Metals pull back. Delivery pressure eases slightly. Singapore reopens after Lunar New Year. First Asian reaction to this move. Their bid or lack of it sets tone for Hong Kong. Day 3, Friday. 3 big clusters. U.S. data, Q4 GDP, second estimate, plus PMI, manufacturing and services, plus PCE inflation at 8:30 a.m. Weak GDP plus weak PMIs plus cool PCE supports weaker economy, dovish tilt. Gold and silver extend, delivery more attractive. Strong GDP plus strong PMIs plus hot PCE, hawkish lean, metals pull back, some longs lose nerve. Hong Kong reopens after 8 trading days. They left with gold around $5,040, silver $78. They returned to $4,993 and 77, almost flat, but after huge volatility. Their choice, buy dip or wait, hints what mainland China will do on Tuesday. PCE specifically is the Fed's favorite inflation gauge. Cool PCE validates the dovish reading of FOMC. Hot PCE supports caution. Weekend, Sat-Sun. Markets closed. Mainland China still closed through Monday. Institutions reposition quietly. Day 4, Monday. Last day of mainland China closure. Light global volume. Hong Kong and Singapore provide some Asian price discovery. Everyone waits for Tuesday. Day 5, Tuesday. China returns Shanghai Stock Exchange, Shanghai Gold Exchange, and Shanghai Futures Exchange all reopen. China is the number 1 gold and silver consumer globally. Their reaction determines direction. If they buy, validates the bull case, lease rates and backwardation can spike, delivery pressure jumps. If they sell or wait, gives bears breathing room, physical pressure eases. Price levels matter. If gold is around $5,050, and silver $79, China might wait or sell. If gold is around $4,900 and silver $74, China likely buys aggressively. Day 6, Wednesday. Open interest becomes the key data point. Did March OI drop from 36666 M toward 250 MIM? Orderly rollover. Is it still above 300 MIM? Heavy delivery likely, still near 366 MIM? System break risk in play? Day 7, Thursday, Feb 26. Final positioning day, historically highest volume of the cycle. Longs decide stand or roll, shorts decide cover, roll, or face delivery. Expect big moves in both price and open interest. Day 8, Friday, Feb 27. First notice. Day standing for delivery numbers publish. COMEX has to allocate metal from the 995 minerals registered, or admit it cannot, and begin forms of cash settlement, rule tweaks. That's when the probabilities resolve into reality. Segment 8, live indicators over the countdown. Over these 9 days, the analysis tracks 5 live indicators. COMEX inventory, 2 p.m. Eastern reports, registered and eligible, daily. If registered continues draining, 785,000 Oz day, you hit 95 melted by Feb 27. If drain accelerates to 1 million per day, you arrive under 90 millisolders, making 20-30% delivery much more dangerous. Open interest in March. If OI drops sharply before Feb 27, longs rolling, squeezes delayed. If OI stays high, longs holding, squeeze odds rise. Lease rates stay around 6.3%, spike to 8-10%, or normalize back to 3%. Higher lease, more intense physical shortage. Backwardation, London spot versus COMEX futures. Today, London spot trades above COMEX futures out through July. If the spread widens, physical premium increasing. If it narrows or flips to contango, some pressure easing. Dollar index and 10-year yields DXY around 97.20 now. Above 97.50 to headwind, below 97.0 tailwind. 10-year at 4.87%, above 4.15% headwind, below 4.0% tailwind for metals. And over all of it, China's action on Tuesday is the ultimate decider. Segment 9. What this actually means for you. This is not about guessing which of 3 scenarios will hit perfectly. It's about understanding what kind of risk you are actually sitting in. 3 key takeaways for a serious silver holder. We are no longer in a comfy coverage world, 102 M versus 3666 MI, projected to 95 MIM versus 3666 MIM at 359.1 leverage is already aggressive. Add 6.3% lease rates and backwardation, and the system is telling you metals are tighter than the price suggests. Today increased the odds that more longs stand high lease rates make borrowing less attractive and delivery more attractive. A divided Fed makes holding metals more rational as a policy hedge. That combination shifts probabilities toward heavy delivery and break scenarios. The risk is now about delivery mechanics, not just price direction orderly scenario. Silver consolidates 75-85, squeeze delayed to April-May. Heavy scenario, silver 90-110, inventories gutted, lease 10%. Break scenario, forced cash settlement, physical premium explodes, silver 120 plus, paper versus metal decouple. If you're on margin in paper, you are betting on the plumbing holding. If you own fully paid physical, you're betting on the plumbing eventually failing. 2 very different games. Segment 10, closing. We are 9 days out from March 1st notice. The math is 102 M versus 366 M today. Likely 95 Mounder versus 3666 memos by the 27th. Lease rates are 6.3%. Backwardation is real. The Fed is divided. China is off the board and then walks back on Tuesday. Physical will win. The only real question is whether March is the month, or whether we get one more delay and the real break comes in April or May. You've been watching John AG here, and I'm OG John AG. If this breakdown of lease rates, COMEX math, and the exact 9-day countdown helped you see what actually matters going into March 27, hit like so this doesn't get buried, smash subscribe with all notifications on, and drop a comment. Orderly rollover, heavy delivery, or system break. Tell me which scenario you think we're walking into and how you're positioned. Because on this channel, we don't just watch price, we watch who's still asking for metal when the notice day arrives.